Hey there, everyone. Happy Thursday, January 9th, and welcome to the show. This is Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from actually another pretty sunny and beautiful day here in Redmond, Washington. I know there are so many weather issues with wildfires in California, and certainly hearts go out to everyone struggling with in that region. Cold and snowy temperatures and conditions elsewhere in the country. Here in Seattle, it's kind of normal, to be honest with you, depressingly normal with a nice misty rain, kind of temps in the 40s and 50s, but we're hanging in there okay. So hope you're all staying safe and doing well wherever you're at. Today, kind of an unusual day, of course, in the markets. The equity markets closed in memory of President Jimmy Carter. And so this is one of those rare times when the NYSE actually closes, not for a normal holiday. So, thinking about what we wanted to do with our episode today, I often get great questions in the mailbag, and I do an all mailbag episode pretty often. We'll actually do a full all mailbag episode on Friday of this week and answer some of the other great questions that we received. But this is a question I've received quite often, and actually I received it a number of times here in the last couple of weeks, going into the holiday and now coming out. And I just wanted to take some time talking about log scale charts. This is an area of technical analysis of which I'm incredibly passionate, and I will tell you why. I am not a big fan of telling people there's a right and wrong way to do things. I tend to see the world not in terms of black and white, but more in shades of gray. That's kind of my personality. And so I hesitate to say there is a wrong way to look at charts, because I try to embrace the fact that there might be a lot of different ways, and some I may not be as familiar with. But this is one where I got to tell you, if you're using the wrong scale charts, I'm going to have to say, as close as I ever will, you're kind of wrong. And here's the reason, right? Log scale charts are a better way, simply a better, more effective, and arguably more, intellectually honest way of representing a trend in a stock or ETF or any other asset class over a period of time. And that's really what log scale charts are designed to do. Now, that's compared to arithmetic scale charts, which are what might be the default chart on the platforms that you may use. So today we're going to talk about what log scale charts are, how they compare to arithmetic charts. I'll show you a series of examples just showing the impact that those that different scale can make. I'll show you how on the stock charts platform, of course, you can set up log scale charts. But to be clear, pretty much any platform I've ever used that is worth using has the ability to toggle between those settings. And I would just take time between now and the next time you're really trying to get into the charts and make sure you're looking at the correct y-axis scaling. All right, with that as an introduction, let's talk about chart scale. So what a log scale chart does, or I guess a semi-log scale chart, which is the technical name for it, is it basically affects the y-axis, which is that the y-axis, the vertical axis on the chart. Here I'm looking at a monthly chart of Apple, and I'm showing it using a log scale. That is compared to an arithmetic scale, which I'll get to in a minute. So what a log scale chart does is 1% has an equal treatment all along the y-axis, right? So if you look here, $1 to $2 is a 100% gain. So that should have about the same distance as 100 to 200, because in percentage terms, that is the exact same gain. So 1% or 100% or 5% will have an equal treatment along the y-axis, which means as the prices get higher, you need bigger percent moves to navigate an equal distance on the chart. A consistent percent move, higher dollar value, but same percent move to have an equal movement on the y-axis. Now I'm going to change it to an arithmetic scale just so you can see what that does. Now here on the monthly chart of Apple, it's going to make it really clear what happened, right? Because back here, and this is a 20-year chart we're looking at, back here in the mid 2000s on an adjusted basis, we're adjusting for splits. A stock like Apple has split a bunch of times in history. So adjusting for splits, we're down here in at $10 a share, single digits back here in 2007, 2008, 2009. And so the entire data series is very compressed because all of the action was within, $10 here. But then when you get higher and you're going, 10 points a month, they're much bigger moves. But in reality, these are actually much smaller percent moves, arguably, than some of the moves you see back here. So by using an arithmetic scale, particularly on a longer period of time, it exaggerates higher price movements and minimizes smaller movements. Now, this is actually a data trick that you will find people use a lot of times if they're being a little bit dishonest in terms of how they're trying to present data. This is sort of the hockey stick effect. If you want to show or imply that something was quiet or calm and then all of a sudden had a huge move, if you make it an arithmetic scale like this, it's going to just make a normal move seem incredibly significant, right? It looks like Apple took off and accelerated to the upside. But this is what actually happened. I mean, this is a much better representation of the pace of the move, because as an investor, you really want to think in your growth as percentage terms, right? If you think about the average returns in the S&P 500, it's about 6% a year, depending on where you start the clock and how much data you're bringing in. But on average, figure about like 6 or 7% a year as average return for the S&P 500. So by using a log scale chart, that would mean if the chart has a particular slope, that is a consistent percentage gain. And that's how you really want to think about your portfolio, not the dollar movements, but the percentage changes, particularly if you're investing in equities and ETFs and thinking about growth over time, right? What did the benchmark do? What percentage return is a benchmark asset or a risk-free asset getting versus my percentage gain in my portfolio? That's the way to compare different portfolios, different groups of stocks on an apples to apples basis. So an arithmetic scale chart means $1 has the equal treatment. A log scale chart means every percent has an equal treatment. And I will tell you, 99% of the time, log scale chart is going to be the right answer. There are very few instances, if any, and I challenge you to come up with one where it makes a lot more sense to use an arithmetic scale. I don't think it exists because log scale chart is just a better way to look at trends over time. Having said that, I will tell you, if you're looking at a very short-term chart, if I'm looking at an hourly chart or like a 5-minute chart, whether I use an arithmetic scale or a log scale, it's not going to matter. They will be slightly different because of the scaling, but not a ton, right? Because in an average week or an average month, a stock like Apple doesn't have huge percentage swings up and down where the log scale is going to make such a difference, right? And give you a different visual representation of the data. It really only happens when you're bringing in longer term data. So I would say using log scale charts all the time is probably the right answer. Does it really matter a ton on an intraday chart? It doesn't. And so, I mean, either one you use, you're going to see almost identical look to it. But I would say, again, the more data you bring in, the more important, the more impactful it can be to use the correct scaling, use the log scale version of things. So, when you think about, trends, I mean, we looked at the chart of Apple there. I would also say, looking at the S&P 500, again, when I'm bringing up monthly charts, that just makes it, so much more meaningful because you're just bringing in so much data. And most, stocks and ETFs have had pretty good runs, anything equity related, right? Generally speaking, equities are a lot higher than they were 10, 20 years ago. And as a result, the log scale impact is so much more meaningful. So here we're looking at the S&P 500. And sorry, I meant to have the charts a little bit bigger. Hopefully you can see it there. Here we're looking at a monthly chart of the S&P 500. And again, when we think about something like the S&P having an average gain of X percent, the log scale allows us to visually track that percentage gain. So if the moving average has a consistent slope, that means a consistent gain in the stock. If the price action has a general trend of a particular slope, that's going to be meaningful. So depending on what charting platform you use, stock charts and other ones that I've seen have regression lines. And forget about the extremes. Just look at that, mean regression. If you have any sort of like least squares regression tool, the slope of the regression line basically gives you a consistent percentage move in the chart, and that's why the slope of that price action is so meaningful. So with an arithmetic chart, the slope of things doesn't really have any meaning. On a log scale chart, it's all based on percentages, which is pretty cool. And I know, like on Bloomberg, for example, and I don't know what other platforms have this. They actually had a way that you can add the percent gain onto a regression channel or a trend line. So you could draw a trend line and actually see the percentage move and see the annualized percentage gain implied by that slope. I wish more charting platforms had that capability because I think it was a really great tool. Just think about what a particular move meant relative to other charts. So that's kind of what log scale charts are. That's why they're important. And again, the longer data that you bring in, the more important that it is. Here's the monthly chart of the S&P. And just to give you that same example, if we make it an arithmetic scale, all of a sudden, the financial crisis looks pretty light. And this sell-off in 2022 looks about even to that. And it looks like we've had this big exponential rise in stocks over the last 10 years. When in reality, if we go to, again, a more corrected version, we can see rightly so that the drop in 2008 was far worse than the drop in 2022 on a percentage basis. And we can see that it's more of a consistent percentage gain off of the 2009 low. After that first rally into 2010, you could draw a line and kind of just capture most of that price action based on the slope of the line. Another thing that's helpful, again, as we're using log scale charts, is that trend lines have meaning, right? So if I draw a trend line with a particular slope, and I don't mean to spend the whole time here on a daily chart or on a monthly chart. So we were looking at a weekly chart of the S&P, and if I draw a trend line, taking the October 22 low and connecting that to the 23 low, and maybe I draw another trend line, taking this point here and connecting it to this point. That move has a certain consistent percentage gain because I have a straight line on a log scale chart. And so by tracking that trend, that means that as long as the stock remains, or as the S&P remains above that trend line, and even if it keeps testing it, that implies that there's a consistent percentage gain implied by that trend line, which means if and when that trend line is broken, all of a sudden the slope of the advance, the percentage gain, is now different. In this case, a lot less than we've experienced since I first drew the trend line. So trend lines all of a sudden take on a little more meaning in terms of what they represent. The slope of anything on the price axis has meaning. By the way, one of the questions I got recently related to this was, how does the scale affect indicators? And the answer is not even a little bit. What you have to remember is, regardless of how you treat the y-axis, log scale or arithmetic scale, all of these are based on the raw data. So regardless of how you show it, the indicators like RSI or PPO, moving averages are not going to, from a numerical standpoint, are going to be identical. Something like moving averages may look different because, again, plotted on the scale, they're going to come out a little differently. But in terms of the raw data, so if you're feeding data into like a trading system or some sort of algorithm, either way makes sense. And it's not going to impact your the indicators at the bottom. Anything calculated from price is going to be identical with either case. So, again, as I'm looking at charts like an Apple or an S&P or anything like that, trend lines really are, I would argue, meant to be drawn on log scale charts, because a trend line on a log scale chart means something. A trend line on an arithmetic scale chart is arguably kind of meaningless because, in terms of what it represents, right? I mean, it's just a line that we may break, but on a log scale chart, it has meaning. Now, this is important to know because if you draw trend lines on a log scale chart versus on an arithmetic scale chart, your trend lines are going to look arguably very different. When the price actually breaks through them or not, and how it lines up to previous data, can very much be impacted, right? Because if you think about those, that big exponential rise, the log scale rise on the S&P, if I'm drawing trend lines, the price action is going to get further and further away from that trend line, even with the consistent percentage gain. But on a log scale chart, the trend line, again, is a better representation of that. And so if you're drawing trend lines at all, if that is a part of your approach to draw trend lines and charts, you really, really, truly need to be using log scale charts instead of arithmetic scale charts. That's a consistent theme to the video. Hopefully you pick up on it. So the visual representation of the trend very much impacted. The slope of different items, particularly trend lines, can be very much impacted. And again, the log scale is a better way to do both of those things. Now, the scaling on the chart can also affect a couple other things that I want to share with you. Number one would be Fibonacci retracements, because those are based on a percent retracement. So the visual impact could be part of it. And then also pattern objectives, right? So when I have a price pattern like a head and shoulders top, and I calculate the price objective based on the height of the pattern, whether or not I'm using log scale charts will very much have implications and impact the results of that analysis. So let's look at those particular cases, because that's where I find people can get dramatically different results depending on what scale that they use. And again, as you'll hear me say a number of times in the video, log scale is the better option in all cases, I would argue, and I'll show you why. Let's look at Moderna. This was actually a stock that we looked at, I think, on Tuesday's show of this week, maybe Monday's. This was a stock that just had a nice bounce. Excuse me. On Tuesday, it actually broke above the 50-day moving average. I think that's why we include it on our chart analysis portion of the show. On Wednesday's session, again, Thursday market closed, but on Wednesday, it gave back a lot of those gains, had a what's called a bearish Harami pattern, if you know your candle patterns, but suggesting some short-term weakness. But when we brought up this chart, we looked at a Fibonacci retracement. So let's look at this, and we basically went from this high in May to the low in June. Now, what you'll note as we're applying Fibonacci retracements on a log scale chart, you can see that even though this is a symmetrical pattern, and it's 38.2% down to the first Fibonacci level and 38.2% up to the first Fibonacci level from below, the scale looks a little off because of the log scaling, right? So a 38.2% retracement has a much further move than this move up here. And let me show you what I mean. That was probably super confusing. Let's look at an arithmetic scale chart of Moderna. All right, here we go. Now let's draw the Fibonacci retracements. And sorry, I'm kind of jumping around between a number of things, but I hope this helps. This is what Fibonacci retracements kind of should look like, right? So with an arithmetic scale, the idea with Fibonacci retracements is once the price has a particular move, once the stock has a particular move, and again, this is because of the history of the indicator, you would take percentages, a visual percentage move from the high to the low, and then calculate a 38.2% move, 38.2% of the distance from that high to that low. So on an arithmetic scale chart, that's what it looks like. 50% is exactly halfway visually. 61.8% is literally visually the distance from 0 to 61.8%. On the way to a 100% retracement. So if I do that same Fibonacci retracement, but switch to a log scale, because Fibonacci retracements are traditionally done on arithmetic scale charts, what you do is you just scale the Fibonacci retracement. So here I can see that a 38.2% visual move on the arithmetic scale actually is stretched to be this high because this is what that level looks like on the log scale chart. So when you draw Fibonacci retracements on log scale charts, it's going to look a little weird. It's going to look a little exaggerated. You can see that the distance from the 0 to 38.2% should be about the same as 61.8% to 100. On an arithmetic scale chart, it would be. On a log scale chart, those are going to come up a little bit. But that's because if you're looking at Fibonacci retracements using the traditional methodology, you would do it on an arithmetic scale. So we need to change that scaling to fit the measurements on this new y-axis, which means if you draw Fibonacci retracements on an arithmetic scale chart or a log scale chart, the results will be identical. So that's how you address Fibonacci retracements. That's why when you see them shown on the program, where I think almost entirely, if not always, use log scale charts, it's going to look kind of like that. And that's the reason. That's why it might look a little different on a charting platform you're using because of the y-axis and how that impacts Fibonacci retracements. But I would argue this is sort of the correct way to apply that methodology. Final indicator to tell you about is price patterns, right? So if you look at our daily chart of the S&P 500, which is this, this is a kind of head and shoulders like pattern that we've talked about. We've talked about our line in the sand around 58.50. And one of the traditional measures that you would do is say, okay, from this point to this point, you can see, you can see over on the left side of my screen, around 4% of a drop from that peak to that value. So what we can then say is, all right, let's take another 4% drop and let's get down to around here. So that would be a similar move. So if I draw a trend line, just sort of measuring the height of this pattern. So I would say, let's say a little arrow like this. So if I do this and say, all right, that is the height of the pattern from peak to valley, I can then take that same arrow and move it down here. That's the same percentage move. So the height of the pattern is based on the percent range of the pattern. And so if it's a 4% drop from head to neckline, I would assume a parallel 4% drop down to the objective. Now, what a lot of people do, the traditional way of doing this sort of analysis using an arithmetic scale, you would do it based on the price action, on the price value. So what you would say is, okay, if this move, hold on, where am I? Here we go. So what you would say is, all right, if this moves 6,100 to around 5,850, that's about what, 250 points, right, from low to high. So I would say another 250 points down to 5,600. So that would be my objective. So I'm basically taking the dollar value or the point value of that pattern and subtract it from the low. So if you're using an arithmetic scale chart, your objective based on a price pattern could be very different. When I'm using a log scale chart, I tend to think that the percent swing implied by the pattern is the more important measure. So when I'm looking at the log scale chart like that, just measuring the pattern and subtracting it from the low gives you the value based on that percentage move. So a lot of times it's going to come up with very similar targets, but I would say that's one thing where I've seen people come up with dramatically different results because they're measuring the height of the pattern on log scale versus arithmetic scale. As a result, the target that you develop could be very different, and that would probably be the reason why. If you ask me, I think using log scale and using the height of the pattern based on the percentage moves, I think is a much better way of measuring that movement. Some would argue that back in the day, people, why didn't they use percentage moves back then? The reason is because all these charts were drawn by hand. It was really hard to draw log scale charts by hand, although some people did try to do it. I know at, excuse me, at Fidelity, I know in early versions of the Fidelity chart room, they had log scale charts that they would just calculate and painstakingly draw to make sure they were accurate. But most people would have done it by hand and would use the arithmetic scale. So price patterns, if you look at like the Edwards and McGee book, a lot of times are implying you do that based on a point total or dollar value of the pattern. I would argue in 2025, looking at the percentage moves makes more sense. So there we go. That is a longer-winded answer, but a hopefully detailed version of why log scale charts make a lot of sense. As a reminder, we talked about log scale versus arithmetic scale, why the log scale chart is a better way to represent a percent change in a chart over a period of time. And again, generally speaking, the longer the period of time that you look at, the more important that scale becomes, right? Because percentage moves are really how institutional investors tend to think of their portfolios over time. I think that's what individual investors should do as well. It's a just better way of thinking about the performance of your stocks or ETFs versus your benchmarks. Percentage comparisons are certainly pretty much the best way to do that. So by scaling your charts in the same way, you will visually analyze what's most important to your portfolio. We talked about how that impacts the slope of the price action and why now that you use a log scale chart, a consistent trend in the chart has a consistent percentage gain. I think that's when the chart all of a sudden takes on additional meaning, which means slopes of moving averages, slopes of trend lines become pretty important, right? And when the trend, when the slope of those lines changes, that tells you that the pace of the advance may be speeding up or slowing down, and that's an important piece of data I think you want to know. We talked about how that can impact things like Fibonacci retracements and how what I would argue the better way to use them, which is just adjusting them based on the log scaling. And then we finally talked about price patterns and the fact that many traditional price patterns have a measurement technique based on the height of the pattern. And I tend to use log scale and percentage moves as a way of projecting those upside and downside targets. And I would encourage you to do the same. Let me know what you think about log scale versus arithmetic scale. What sort of lessons have you learned using these different charting types? What mistakes have you made? Drop a comment. Let me know. Very interested to know what else you've come up with. Also, by the way, when the markets close, I like doing a special episode like this. What other topics and indicators can we dig into on these holiday events? Drop a comment. Let me know. I'd love to hear your ideas. That's it for today. Thank you guys so much for joining me on a market close day, but still an important day to try to learn and improve your understanding of technical analysis and the markets. For Market Misbehavior, I'm Dave Keller. Remember, it's always a good time to own good charts. Have a good night, everybody.